Morning, everyone. All right. My name is Vays. I'm not going to spend too much time talking about myself. I'm former Wall Street. I currently have a very popular Twitter account at Vays. And find me on YouTube. Just Google Vays on YouTube, and all my information is there. I have been, last time I was at this event, I gave a presentation about the history of Bitcoin and why Bitcoin is important and why Bitcoin blockchain matters economically and technologically. But over the last 6 months, I've really seen the ramping up of ICOs. And because of my popularity and YouTube channel, I'm constantly getting people asking me about can they advertise their ICO. And I had to go ahead and alter my LinkedIn description, and here is what it now says. I am not interested in your ICO or token sale. Please send all requests to Vitalik Buterin, who's responsible for this nonsense. So I am a bit of a critic of ICOs, and throughout this presentation, I want to explain to you why I have been a critic of ICOs from the very beginning. What you see behind you is the NASDAQ bubble from 1998 into the top of the bubble in 2000, and then into the lows, and then it took about 5 years to get back to the new high of the dot-com bubble. And I want to spend this presentation talking about the monster similarities that I have seen between the current ICOs and the dot-coms. And hopefully you'll realize that nothing that's happening right now is new or innovative. It's all happened before, mostly all because of hype. Okay, so here's a zoomed-in version of the dot-com bubble of the 90s, and Yahoo was one of the Yahoo was one of the first big companies to go IPO, and they did well. The stock closed at about $33 at the end of the very first day of IPO. They gained 50% that day, so that means they opened around $16.50. And they closed at 33. After split adjusting, it's as if they opened at $1.38. Alan Greenspan in December of 1996 called it irrational exuberance, and he was very, very wrong, as the dot-com bubble continued to grow heavily soon after that. Amazon went public. Their stock only went up 31% on that first day, closing at $23 a share. After split adjusting, it's as if it was $150. So I want to talk about the more interesting situations that took place during the dot-com bubble and some of the really, really hyped IPOs. One of the notable ones was the Globe.com IPO. That IPO soared over 600%. I don't want to block anything. That IPO soared over 600% on opening day. So what was the Globe.com? The Globe.com was a way for you to have your own customized web presence. And to me, this is very, very similar to today, where everyone feels like they deserve to print their own money. The Globe.com allowed them to have their own internet presence through a centralized website, something we all do today by simply creating a website. And the stock was supposed to open at about, I believe it was $9 a share, and it closed at the end of that day at $87. Oh, sorry, it opened at 87. It was supposed to open at 9, and then it traded down to 63, where it closed for the day. Of course, the Globe.com was eventually delisted. Lots of lawsuits came in as the company couldn't really build anything. Now, that 600% day one increase was broken a little bit later by a company called VA Linux. VA Linux changed its name a couple of times, and when that stock opened, the opening price was supposed to be about $30-something a share. The first trade took place at $299 a share. So it was almost a $700 increase between the price it was supposed to open at and the first trade. As you can see by the chart, the first trade took place at $299, and over the next year, the value of the stock fell all the way down to $8. VA Linux was like a Dell, but for Linux instead of Windows. So that was the company that broke the record. And here's a company that I personally remember. I was in college. There was a company called Cyber Rebate. There was so much hype around this company. Let me tell you the business model. It was a great one. So they would sell you mostly tech gadgets at 10 times the going rate. Like you can go to Best Buy and you can buy something for, let's say, $10. You can buy it from their website instead of for $10 for $100. But then you can submit a rebate and get your entire $100 back. So their amazing business model was that approximately 50% of the people will not request the rebate checks, and they would have all this extra money by selling you a product at 10x. I remember, I think I got all my rebate checks because we were broke college students back then, but that was the business model. They ended up blowing through $80 million, and at the end, there were 9 customers who were owed almost $100,000. They ended up making 9 cents on the dollar. So all those people ended up losing 91% of all of the money that they put into it. So look, there was lots of money that could be made on hype and a bubble. The question is, who realizes that they're getting lucky and who doesn't? Those that realize what is actually going on have the opportunity to get out at the top. And here's one example of someone that got out at the top, and that was Broadcast.com. So Broadcast.com, well, they changed their name a few times. Before Broadcast.com, it was AudioNet. So here's the story of AudioNet. Before AudioNet, before they changed the name to AudioNet, Mark Cuban invested about $10,000 in this company, and Mark Cuban's main interest was to watch his alma mater's college basketball games and listen to them, not watch, but listen to them on the internet. So Mark Cuban basically wanted to put radio on the internet so he can listen to basketball. With his $10,000 investment, he was a part owner. He seemed to have a better head for business, so he was able to convince the founder and CEO to hand him control of the company in order to take it to the next level. Name was changed to AudioNet, then to Broadcast.com. When Broadcast.com went public on the stock market, Mark Cuban was worth a few $100 million. 9 months after they went IPO and they had their own stock, Yahoo bought them out and making Mark Cuban a billionaire. When Yahoo bought out Broadcast.com, they valued each subscriber of the website at $10,000 a person, okay? 2 years later, Broadcast.com was delisted. So basically, Mark Cuban was able to cash out his $1 billion in Yahoo stock, and then 2 years later, Broadcast.com was no more, okay? So talk about knowing when to get out at the very top. Here's just a list from Wikipedia of all the other companies that were very interesting, at least interesting enough to have their own websites. As the NASDAQ crashed 78% in value. The interesting thing is, as the NASDAQ was crashing and all these companies were, becoming, I guess, future Wikipedia examples, the amount of people using the internet continued to rise. This did not actually affect the usage of the internet. I'm actually very curious if the usage of the internet went down during the 2008 bubble, because in 2008 bubble, so many people lost their jobs and it was so devastating that I'm sure in America, internet usage went down, and because people were probably spending a little less money on high bandwidths and stuff like that. So here are a couple of other examples that I found interesting. One of them is eDigital. So what became very popular in the late 90s is simply changing your name to something tech-related. So eDigital was a communication company that was public on the stock exchange. By changing their name to eDigital, their stock went from 6 cents to $24, okay? Just by changing the name. And this happened in right near the end. This happened in 1999. So it was initially a 6-cent stock. And we're already seeing this happen. in our current environment, here's one example. The SEC already went after them. So another penny stock announced that they were going to start an ICO, and there goes the price of their stock. And then about a month later, the SEC gets involved and shuts down that company. And here's a better example. Here is Long Island Iced Tea source, because they've changed their name to Long Island Blockchain. And the stock of this company literally went from, what do we got? It was like a sub $2 stock, and it went to $16 that same day. The company was literally making iced tea, and all they did was change the name, and their stock went from under $2 all the way to $16. And it was interesting to read some of the quotes. I don't have this one highlighted, but at the bottom there, it says, someone was quoted as saying, "It's so reminiscent of what happened in the late 90s. It was an author of one of the books. A company that had nothing to do with the internet would put out a press release that they were going to become an internet company, and the same thing is happening right now, just to have your stock soar." So again, most of the stuff you're watching right now has not changed. Here's an interesting one. Pets.com. Everyone loves to make fun of Pets.com. Pets.com came out about 9 months after Amazon, and guess what? Amazon is Pets.com. Pets.com is Amazon. There was like 2 differences, but besides the name. Amazon started selling books. Pets.com started selling pet supplies. And this goes to this idea that crowdsourcing, and the crowd knows best of what to invest in. I'm sorry, guys, the crowd doesn't know best what to invest in, okay? And this is a prime example. No one could have known that Amazon would be one of the world's biggest companies, and Pets.com would be a laughingstock. And you know who didn't know that? Amazon. When Pets.com was launching, guess who the biggest investor in Pets.com was? It was Amazon. Amazon was the biggest holder. Amazon was the biggest pre-IPO shareholder of Pets.com. So it goes to show you that even Amazon didn't know who was going to win the online merchant game. The same thing can be said about Facebook and MySpace and Friendster, and I can keep naming them. There was High Five, there was Wimit, there was all of them. Everyone likes to say was, well, how come the rich people got to profit from the Facebook? Well, guess what? The average person probably would have had all their money in MySpace. Okay? And this is why some things should be for qualified investors, mostly because they have the ability to lose that money. And I heard in a previous presentation, someone was accusing Facebook of like making all this money, not kicking anything back. Guys, Facebook stock was $20 a share when it launched. It IPO'd a little bit overhyped. It was at 40 bucks. Within a month after Facebook IPO, the stock dropped to $20. You could have bought it. You could have made 10 extra money on Facebook stock. It's a public company, right? They're not taking your money. They're giving it back to you. You can be a shareholder of Facebook. No one is stopping you. Not a good idea now with their data leak dropping their price, but they'll be back. So you shouldn't think of it that way. So there you go. There's the Pets.com example. So a lot of stuff that is happening right now happened before. I mean, here's a video. Let's see if we can play that. This is a commercial from the 90s.
Gotta get a gift for a kid, and you don't know what they want because you're old. Old, honey. Give them Flu's online gift currency. It's just like money. You send it by email, they spend it at some of the web's coolest stores, and you come out hip and smart. Congratulations, baby. Duh.
So this was an attempt to put money on the internet. Flu's was basically the Bitcoin before Bitcoin. Okay? So again, a lot of this stuff is not new. Let's go back to full screen. Perfect. Thank you, guys. And here's Flu's. So Flu's was an attempt to have decentralized money on the internet. The problem was it wasn't decentralized. And what ended up happening was, in 2001, Flu's was notified by the FBI that the Russian organized crime syndicate was using Flu's and stolen credit card numbers as part of a money laundering scheme in which stolen credit cards were used to purchase currency and then redeemed. So there you go. So again, Flu's ended up blowing through $50 million in an attempt to put currency on the internet. This one, most people have completely forgotten about that. Here's a really cool story that I started Googling. All right, what other interesting things happened during the dot-com days that I can see happening right now. And one of them was this story. Someone talked about a story how, again, a guy had some kind of an interesting idea in communications, so he built a nice website, and he got a little bit of money, and he used that money to create a giant billboard advertising his company. And just because of that, another company bought him out for $100 million, but gave him a contract that said, hey, you have to help integrate this product into our company, so you can't collect your $100 million for 3 years. Within about 3 to 4 weeks, maybe a few months, the company realized how useless he actually was. So they said, hey, why don't you just take the $100 million, you can go away, we will go ahead and integrate it. So when he took the $100 million and walked away, he realized that he didn't really have an idea. And what does this say about the company that just paid him $100 million? He ended up shorting that company by buying puts, making another $100 million on top of that. So when I read this story, all I could think of was the Consensus Conference back in New York last year, where you see these giant EOS billboards all over Times Square. So again, of something that hadn't even launched yet. So I found that very interesting. EOS is still up and running, so the jury is still out on that one. All right, so let's talk about how a lot of these things end, right? Everyone thinks that, well, let's see what happens when the regulators get involved. So here's an example. Everyone has seen the movie Wolf of Wall Street, right? I should say, who hasn't seen the movie Wolf of Wall Street? If you haven't, you really should watch it, preferably without the kids around. So Jordan Belfort, so he went to prison in 1999, basically for running penny stock pump and dump scams. Okay, and let's watch this very quick clip from Wolf of Wall Street. Listen carefully.
An IPO is an initial public offering. It's the first time a stock is offered for sale to the general population. Now, as the firm taking the company public, we set the initial sales price, then sold those shares right back to our friends. Look, I know you're not following what I'm saying anyway, right? That's okay, that doesn't matter. The real question is this: was all this legal? Absolutely fucking not. But we were making more money than we knew what to do with.
All right, so he explains it right there what they were doing. They had the ability to take companies IPO. And what they did was, by having that ability to take companies IPO, they were basically setting their own price of the IPO. They were selling the initial shares to their friends, and that's how they were making money on top of that, and their friends were making money giving them a kickback. To me, I don't understand how 90% of pre-ICOs are doing anything different than what Jordan Belfort was doing. You set the initial price yourself, and you tell all your friends about it first, and you make sure your friends get in on it first. People always say it's so expensive to take a company IPO. You have to go through Goldman Sachs or JP Morgan or Morgan Stanley, but that's why. Because if anyone has the ability to go IPO, they just give it up to their friends. That's the same thing that Jordan Belfort's doing. Here's another case of investment banker Frank Quintor gets 18 months for obstruction of IPO probes. And this guy worked on companies like Amazon, like Netscape. I think he was even somehow involved in Google's IPO. And I mean, this case got very, very complicated. He actually did not end up going to prison. Oh, I got more fans here. Probably very few, considering the audience at this conference. But so look, people did have a lot on the line, and a lot of people got in trouble for it. I'm running low on time, so I'm just going to close out by saying I started thinking about this a little bit, and I was still in university during the time of the dot-com crisis, but I remember how one of the guys in my dorm started trading penny stocks. And this is how I see all of these old coins and all of these ICOs. I see them as penny stocks. I remember my dorm room mate was trading penny stocks. And what fueled the dot-com bubble? The biggest thing that fueled the dot-com bubble was these barriers to entry got broken. I think that E-Trade and Scottrade and these online brokers made it so easy for pretty much anyone, but almost anyone, to become a trader. This is how your cab driver, your barber, your shoe salesman, this is how they start telling you about the latest IPO, because they now have the ability to open an account from their home. They don't need a broker. They don't need like a professional to make trades. They can do it themselves, but they still had to be residents. They still had to be 18. They still had to have a bank account, and in order to be a pattern day trader, they needed $25,000. All of that went away with blockchain. No geographical restriction, no age restriction, no financial barriers to entry, and now what you have is 15-year-olds emailing me for trading advice. Right there, I am 15 and a half years old and in high school, asking me when is the best time to buy Bitcoin. This one is better. I didn't even understand it at first when he says, oh yeah, of course I'm going to like that ICO. I'm 13, so I would like it. I'm like, what do you mean 13? And he has to clarify, because I'm 13 years old. So these are the kinds of traders that are going to end up trading your ICO on these decentralized exchanges. So just keep that in mind. All right, I'm going to skip this. I'm going to skip the Bitcoin Dominance Index. And finally, I just want to close out with a couple of statements from Alex Marcos, where he says there's one big difference between traditional startup funding and ICOs. Founders of failed startups should not walk away financially enriched. He goes on to say that, hey, you know, speculative investment is good, but the incentives need to be aligned, and creators of companies should not get rich, you know, at the expense of their investors, because now anybody can be an investor as they move on from one blockchain project to another blockchain project to another blockchain project. Here's one of my tweets trying to explain the difference between Bitcoin and ICOs. I believe all ICOs are centralized, and that's pretty much it for my presentation. I will just close out with my view on Ethereum, because a lot of people ask. I think Ethereum has 4 issues with it, and any other ICO has at least some, if not all, of the same issues with Ethereum. I think Ethereum has a regulatory risk, because I believe it was launched as an unlicensed, unregistered security with their pre-ICO and ICO. I think it has a lot of technological risk because it's an unproven blockchain that wants to go proof of stake, and no one is capable of downloading that entire blockchain. I think it has economic risk. I don't believe in application tokens. I don't believe you should turn every user into a speculator. I don't pay Amazon stock to buy on Amazon. I shouldn't have to pay in Ethereum money to run a smart contract. And the idea of smart contracts, decentralization is a tool to prevent censorship resistance. We need censorship resistance in money. I'm not sure we need censorship resistance in contracts. No government entity is really censoring your contracts unless those contracts are very, very illegitimate. All right, I'll close off on that note. Please find me on the internet, Tone Vays on Twitter, Google me on YouTube. You'll find my YouTube channel. We cover blockchain news every day, a bit of skeptics on a lot of these projects. But hey, I love Bitcoin, I love trading, and find me here. I'll be around most of the day. Thank you, guys.